an interest rate hike by the US Federal Reserve does pose challenges and opportunities for all parties involved. Now, at this particular point, for developing countries, that is our essential focus. The US economic expert David Dollar says that whether it's good news or bad for different countries does depend on their individual situation. Nonetheless, developing economies should not be panicking about a potential financial crisis. He notes that emerging economies have seen strengthened capabilities in how they deal with impacts and risks in the financial market ever since 2008. Now, the US Fed decided to raise its benchmark rate by 25 basis points.
Interest rate increases from the Fed, I think, are both good news and bad news for developing countries. The good news, it's a signal that the US economy is doing better, so the US will import more, and that provides spillover benefits to our partners like China. On the other hand, the cost of capital is going up. China may have to raise interest rates itself to manage its currency and to deal with the financial risks that are building up in China. Many countries do a certain amount of borrowing in dollars, so their cost of capital will be going up. Their currencies will probably depreciate a little bit, and that can actually be helpful to spur their exports.
Let's dig a little deeper into exactly what effects this will have, starting with the most liquid capital market on the continent. Angelo Coppola joins me now live from Johannesburg. Angelo, the rand did claw back a few of the gains today. It shot past 14 rand to the dollar at one point, went back under that level. But wasn't this rate hike already priced in, at least from the perspective of traders in Johannesburg?
Well, an investment analyst tells me that the move in the rand, or the ZAR, is more noise than anything else. It was priced in. So the move today is more to do with the dollar strength than a pricing in of a rate hike announcement yesterday. As you know, the rand is one of the more heavily traded currencies, and the rate hike was always going to strengthen the dollar at the expense of the emerging and other market currencies. Traders will, of course, arbitrage that strength for their own account. And of course, when the ZAR moves, the local bourse also moves. In this case, the JSE was down almost 2% on the day. So it wasn't a good day all the way around, Rama.
Indeed. Is a slightly weaker rand, though, on the whole? Is it a net positive or a net negative, especially for South African miners and manufacturers?
Well, Raman, we have this conversation on a regular basis. We have had a weak currency in South Africa for some time now. Many businesses in those two sectors haven't really benefited from a weaker currency because much of the equipment they need to manufacture or dig is bought using US dollars. But you'd also think that the weak currency should make miners more attractive acquisition targets. Ironically, though, that hasn't been the case because the country's governance situation is rather murky and the legislative environment remains uncertain. So this is especially the case in the mining sector. So at the moment, that currency benefit is not there, Raman.
Indeed. I understand you're also now joined by Daniel Rangers live from Washington, D.C. Daniel, how much stock are markets putting into this forecast of about 3 rate hikes coming through next year from the Fed?
Well, it dented the bull rally for a while yesterday, bringing down the valuations of stocks between about 0.8 and 0.5% or so. But today, the bull rally has continued and the Dow is heading back to its sort of historic level of 20,000 almost. And if you look at the valuation of the S&P, the 500 large stocks in the US, we're at levels of about 26 and above. So that means if you invest $26, you get $1 back, in essence. So why are people spending so much on stocks? Well, they're optimistic about the US economic data coming out. That's a reflection of what the Fed's been doing. But as well, there's quite a lot of optimism about Trumponomics. So that would be the combination of infrastructure increases to the tune of about $1 trillion. And then, more importantly, corporate tax reductions, which he's aiming to have about $6 trillion worth of them, and then some other regulatory changes that would make it easier for the financial community and such. So there is this sort of stimulus impact that is being anticipated in the markets. Mm-hmm. And so the fact that the Fed has anticipated more rate rises in 2017 hasn't really dampened that enthusiasm, Raman.
Indeed. Let's talk about that Trumponomics that you just raised there. I mean, the next phase here is that the heavy lifting will actually shift from the Fed and right into fiscal policy, at least with the Trump administration in charge. But these two bodies don't necessarily see eye to eye. What sort of disputes are we likely to see between the incoming president and Janet Yellen?
Well, Janet Yellen's going to try and avoid politics, but she's already sort of weighed in a subtle way during her appearance after the announcement yesterday. And that was, she talked a lot about productivity growth. There is still in the United States, despite the success, a productivity gap, which means that underlying all of this enthusiasm and energy in the US economy, there's still a problem in making the US economy more productive overall. And she's basically saying if you want to spend money on things, you need to look at things like innovation, education, making workers more efficient, all of those kind of things, rather than an across-the-board spending pattern on infrastructure and corporate taxes. She didn't say that explicitly, but essentially what she's saying to Trump is, if you're going to just put sugar into the economy, it's not going to have a long-term impact. In fact, it's going to cost a lot of money.
Indeed. We'll have to leave it there for the time being. Should be interesting to see exactly how that circle gets squared out, as it were. Daniel Rangers live in Washington, D.C. and, of course, Angela Gupta live in Johannesburg. Gentlemen, thank you.